Monday or Tuesday. I would say the anyway. Chapter 13 talking about the decision making. Learning objective number 1, identify relevant and irrelevant costs and benefits of the lesson. So chapter 13 and 14, which is important, talking about decision making. The first thing in chapter 13, we're talking about the relevant and irrelevant decisions, which is related or it is important to a decision making or not. Saying relevant information, which means it is important for the decision. Irrelevant will be not important for a decision. Okay. So the first key for the decision making, every decision involves choosing from among at least 2 alternatives, which means if you have one alternative only, you don't have a decision because you don't have to choose between 2 alternatives. So at least you have 2 alternatives to make a decision. So you will evaluate the information for the at least 2 alternatives to make a decision. So the first step in decision making is to define the alternatives being considered. Key concept number 2, once you have defined your alternatives, 2 or more at least, you need to identify the criteria for choosing among them. Relevant costs and relevant benefits should be considered when making a decision. Irrelevant costs may be the most important concept for this chapter, which is 13, the distinguish between relevant and irrelevant. So the irrelevant costs and irrelevant benefits will be ignored when make your decision. It is irrelevant means I will not take into consideration to make my decisions. Number 3, key number 3, the key to effective decision making is something called differential analysis. If you remember this word from chapter 1, differential means the difference between 2 alternatives at least, focusing in the future costs and future benefits that differ between the alternatives. So everything else is irrelevant and should be ignored. So the difference you will consider the difference between the 2 alternatives in making your decision, and this is called differential. If we talk about the costs, then we are saying differential costs, the difference between 2 alternatives in cost, or differential revenues, which is the difference between the 2 alternatives in regards of revenues. Do you remember the word incremental? What is the incremental? Additional. The incremental word, which is that additional. I have that base. So any additional revenues or costs will be considered. Incremental costs is the increase in costs between 2 alternatives, and incremental benefits or revenues, which is the increased benefit or revenues for or between 2 alternatives. A word or a concept in cost accounting called avoidable. What does the avoidable word means? I can avoid it means I will consider that in my decision. Avoidable costs is the cost that can be eliminated, can be avoided by choosing one alternative over another. So avoidable cost, which means I can avoid it, which means I will consider it in my decision. Concept number 4, if you remember the word sunk cost, something happened in the past, Costs or sunk costs are always irrelevant. Why? Because it happens in the past, because it is something related in the past. So the cost or the sunk cost will be irrelevant for our decision. Is a cost that has already been incurred in the past and cannot be changed regardless of what the manager decides to do. So if you choose alternative A or alternative B, the sunk cost will not differ, will not be different. So it will be irrelevant for our decision. Future costs and benefits that do not differ between alternatives are also irrelevant for the decision-making process. You have the same cost between option 1 and option B, so it will be irrelevant. Why? Because if I'm choosing A, I will pay that much. If I'm choosing B, I will pay the same amount. So it will be irrelevant for our decision. So far, in objective number 1, we are talking about irrelevant and relevant costs. Irrelevant and relevant costs. The last concept, which is called the opportunity cost, is also need to be considered when making our decision. An opportunity cost is the potential benefit that is given up when more alternative is over. So if you choose your current choice, which means I forfeit means I given up another alternative. So this is called the opportunity cost. Any questions so far? Okay, we have an example here for relevant and irrelevant costs. Cynthia, a Boston student, is considering visiting her friend in New York. So a student is thinking to travel between 2 cities. She can drive her car or take a train by car. It will be 230 miles to her friend's apartment. If I'm using my car, I will drive for 230 miles between the 2 cities. She is trying to decide which alternative is less expensive and has gathered the following information. Automobile costs based on 10,000 miles driving per year. So your decision now to use your car or take the train. If you are thinking about the costs, then you will give me some information related to the costs only. So these costs or information based on 10,000 miles driving per year by the car. So the annual straight line depreciation on car, annual means per year. Depreciation, depending on the straight line, will be 2,800. And this number is calculated from what? The cost, as you know, cost minus the salvage value of the car, all divided by how many years do we drive our car. If I'm using the straight line, so the years is the base. So 2,800 will be the cost of the depreciation for the car, and per 1 mile, which is 2,800 divided by 10,000. So per mile will be 280 cents, the cost of depreciation. The cost of gasoline will be 100 cents, $0.1 per 1 mile. Annual cost of auto insurance and license, 1,830 per year. And then depending on the 10,000 miles, the cost per 1 mile will be 138 cents or $0.138. You have to think about, is it relevant for my decision or not for each of these information. Maintenance and repairs, I'm paying 65 cents, 0.065 for the maintenance and repairs. Parking fees at your school, which is Boston, which is the first city. I'm paying parking school $360 for the parking for my school, and the cost will be 0.036 per mile. Total average costs will be 619 cents per 1 mile. Okay then. Just for our information, the parking fees I'm paying per month, $45 per month, multiplied by 8 months in the school, so I'm paying that much, 360. The gasoline is calculated 2.7 per gallon, the price per gallon divided by 27. Now, our decision is which information of these should be relevant and which should be irrelevant for our decision. Additional information, if I'm using my car, I will have something called reduction in the resale value. Resale value. If I'm using my car more, which means the price, the market price for the car will be less. So the reduction in the resale value of the car per 1 mile will be 0.026. The round trip ticket or train ticket, the round trip train ticket, I will pay $104. So this would be the main point that I'm comparing between the two alternatives. If I'm using the train, then I will pay $104. Benefits of relaxing on the trip, on the train trip. What is that? I cannot calculate the benefit. Benefit on relaxing on the train trip. It depends on the person. It depends on the person. Most likely, if you like, some persons are refusing to use the planes. So if it is free, I will not use it. Why? Because I don't like to use the plane. Similarly, the benefits of relaxing on the train cannot be measured. So it depends on the person. It depends on the person. Any amount will be acceptable for this. Cost of putting a dog in a kennel while gone. So if I'm using my car, I need a box for that animal or for the dog. Or if I'm using the train, similarly, I will pay the $40, the kennel for the dog. Benefit of having a car, again, benefits of having a car in New York cannot be measured, depends on the person. The hassle, what is the hassle? Yes, the hassle of parking car in New York, exactly like you're parking around the university. The hassle of parking a car in the New York, again, we cannot measure this amount. Per day cost of parking a car in New York, I'm paying $25 if I need to park my car in New York. So which information are relevant in this decision and which are irrelevant, which costs of and benefits will be relevant in our decision. The cost of the car itself, is it relevant? No, why? I already paid, which means it is a sunk cost, and it is not relevant for our decision. The annual costs of insurance, I'm paying, if you remember the question, I'm paying a license and insurance for my car. Either I drive to that city or I will not use it for traveling, I'm paying the insurance and license. So the annual cost of insurance and license will not be relevant because it will not differ between the alternatives. It will remain the same if she drives or they take the train. However, the cost of gasoline, is it relevant? Of course. Definitely yes. If I need to travel to Aqaba or the long distance, I will think about the gasoline cost. If she decides to drive, then the gasoline cost definitely will be relevant. She would avoid the cost of the gasoline if I take the train. So the cost differs between the alternatives. Remember the criteria. The cost should be different between the two alternatives. And in this case, I will consider it in my decision. The cost of maintenance, and repairs. If I'm using the car, then I need more maintenance and repairs for my car. In this case, this will be relevant. In long run, these costs depending on the miles that you drive your car. Then if I'm using my car more, I need maintenance and repairs more, which means it is relevant. I'm paying the monthly school parking. Either I take the train or I drive my car to another city. So this will be irrelevant, the monthly school parking fees, because it must be paid if Cynthia, the student, drives or takes the train. I'm paying already the parking fees for my school if I drive or I didn't use my car. At this point, we can see that some of the average costs of 6.19 cents per mile are relevant and others are not relevant. So the decline in the resale value, if you compare between a private car and a taxi car, the resale value definitely is different. Why? Because the taxi is used more. If you compare between a private car and the taxi car, definitely the resale value would be less for the taxi. Why? Because the miles are bigger, the kilometers are bigger. So the decline in the resale value due to additional miles is relevant for our decision, which means I will keep my car without using, and I will prefer, if I'm thinking about the resale value, I will think about the train. The round trip ticket, is it relevant? Definitely yes. The round trip ticket or train fare ticket is clearly relevant. If she drives, the cost can be avoided. If I use my car, I will not pay the train ticket, which means it is relevant. Relaxing, as we say, relaxing in the train is relevant, but cannot be measured, which means I will not consider this in my decision. Relaxing in the train is relevant, even though it is difficult to assign a dollar value for this benefit, which means I cannot estimate this amount. The canal cost, if I'm paying the canal cost for the two options or two alternatives, it will be not relevant because it will incur if she drives or take the train. The cost of parking in New York, not in your school, is it relevant or not? New York, like London, it is a hassle to find a parking and it is expensive. So the cost of parking in New York is relevant because it can be avoided. It can be avoided if she takes the train. The benefits of having a car in New York and the problems of finding a parking space are both relevant, but are difficult to assign a dollar amount, cannot be estimated. It will be relevant, but if I cannot measure it, then I will not consider it in my decisions. From the financial standpoint, which means it excluded the benefits or the personal variables, if you like. From financial standpoint only, Cynthia would be better off taking the train to visit her friend. Some of the non-financial factors may influence her final decision. Relevant financial costs of driving. Relevant financial costs of driving. Again, just to stress about this word, I'm talking about financial variables, which means if there is a person or personal variables and they are important for that decision, I will go for that regardless of the cost. So the relevant financial cost of driving, the gasoline, 460 comes from 460. The miles, the round trip, the two ways. The one way is 230 miles. So the two ways or the two directions will be 460 multiplied by 100 cents. So the cost of the gasoline will be $46. The maintenance per 1 mile will be 0.065 multiplied by 460 per the miles or the distance, and the cost of the maintenance will be 29.9, and this is estimated. A reduction in the resale value, 460 miles multiplied by 0.026 per mile will be 11.69. The parking in New York for 2 days, I'm paying 25 per 1 day. So the cost for the parking will be 50. Total costs, if I drive my car, will be 137.86. I will compare this amount with the round trip ticket per train, and I will avoid all of these. Then the round trip cost will be better, which is $104, comparing to $137. Any question for this, guys? Any question? Hello, guys. This is the second part for lecture 1. We covered learning objective number 1 up to our example of traveling, Cynthia traveling. Then we will continue now for the total differential cost approaches, the total cost approach. Example, the management of a company is considering a new labor saving machine that rents for $3,000 per year. Data about the company's annual sales and costs with and without the new machine are. Now, the question is, or the example talks about a company needs to install a machine instead of labor. Then if I include the machine, I will pay $3,000 per year for that machine, and we do have a saving in our labor. Okay. The information, the sales, 5,000 units, and the price is $40 per 1 unit. So the current situation, I'm selling $200,000. With the new machine, we still have the same level of sales for $200,000. So we don't have differential benefits for the machine. Differential means the difference between two situations. The first situation with include the labor without a machine, and the second situation with the machine instead of labor. The less or the variable expenses, direct materials, we will have the same materials, because again, our question is including the machine instead of labor, not the materials. So we do have 5,000 units multiplied by the cost per 1 unit in materials, $14. So the total cost of materials would be 70,000 in both cases. Now, the direct labor, the cost for 1 unit is $8 for the current situation. So 5,000 units multiplied by $8, and the cost for the labor would be $40,000 for the current situation. If we include the machine, then we are saving $3 for the direct labor cost, and then the cost for the new situation with the new machine will be 5,000 multiplied by $5, and the cost will be $25,000. So in this case, we say the differential costs between the two situations, we save $15,000 in the direct labor cost, which is the difference simply between the 40,000 and the 25,000. The last column again, which is the differential costs and benefits, which is the difference between the two situations. We save some costs here, which is $15,000. Variable overhead, $5,000 times $2 per 1 unit. Most likely, the variable overhead will be allocated, which means we will pay the same amount when in the two situations. So we don't have any differential costs for the variable overhead. Total variable cost for the current situation is $120,000. With the new machine, we have $105,000. The contribution margin, which is the difference between the sales and the variable expenses, for the current situation, we have $80,000, which is the difference between $200,000 and $120,000 total variable cost. So the contribution margin will be $80,000. For the new situation, which is with the machine, the $200,000 minus $105,000. So the contribution margin will be $95,000. The last column means we are saving 15,000, or if you like, we will have additional $15,000 in the contribution margin if we include the new machine. Minus fixed costs, other fixed costs, 62,000 in the two situations, which means these fixed costs are paid regardless the option. With the current situation or including the new machine, we are paying the 62,000. The rent for the new machine in the second situation, we will pay 3,000 rent for the new machine. So in this case, the total fixed costs for the second situation will be 65,000 comparing to the fixed cost in the current situation, which is 62,000. Differential costs, 3,000 between brackets, which means we will lose additional 3,000 if we include the new machine. Net operating income for the current situation will be 18,000, which is the difference between contribution margin 80 minus 62,000. Net operating income will be 18. If we include the new machine, then the new operating income will be what? Will be 95 minus 65. So we will have a net operating income of 30,000. The last column means we will have additional 12,000 in the net operating income if we include the new machine. And this is called the differential cost approaches, differential cost approach. Now, as we can see, the only costs that differ between the alternatives are the direct labor costs, savings, and the increase in the fixed rental cost, which appears in the last column. We can efficiently analyze the decision by looking at the different costs and revenues and arrive at the same solution. So we can say the financial advantage, in this case, it will be an advantage. Why? Because we do have a positive number. A positive number means we will increase our net income if we include the machine. So the financial advantage of renting the new machine will be the decrease in the direct labor costs, which is 15,000, comes from 5,000 multiplied by $3 per 1 unit. And this will be compared to the increase in the fixed costs or expenses of 3,000. So we do have a financial advantage of renting the new machine, or the option or the decision that we are trying to have, for $12,000. Using the differential approach is desirable for two reasons. Only rarely will enough information be available to prepare the detailed income statements for both alternatives, which means we can use these two numbers only, which is differential, or the difference between the two situations. So we will include the numbers or the costs and revenues that differ between the two alternatives. Mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is rarely or really critical. So again, we will analyze our decision by the financial, or computing the financial advantage for the decision, which comes here, for our example, the difference for the labor costs and the difference of the fixed costs. Learning objective number 2, prepare an analysis showing whether a product line or other business segment should be added or dropped. One of the most important decisions that the company can take, adding or dropping a line or a segment. Dropping means deleting or closing. So one of the most important decisions managers make is whether to add or drop a business segment or line or branch. Ultimately, a decision to drop an old segment or add a new one is going to hang primarily on its financial impact. So to assess this impact, it is necessary to carefully analyze the costs. Now we have an example for Lovell Company. Due to the declining popularity of digital watches, Lovell Company's digital watch line has not reported a profit for several years. Lovell, the company, is considering whether to keep this line or product line or to drop it or stop it. So our decision to keep this line or to stop it. Decision rule: Lovell should drop the digital watch segment only if its profit would increase. So our decision depends on the profit. If we decide to close, which means our profit should be increased. Otherwise, this will be a problem. If we close the line, and our profit will be decreased, then we will keep this line. Now, Lovell will compare the contribution margin that would be lost if the digital watch line was discontinued or stopped to the fixed expenses that would be avoided if the line was discontinued or stopped. Now, we do have the information related to the digital watch line or segment. We do have sales for $500,000. Variable expenses. We do have variable manufacturing costs for $120,000, variable shipping costs for $5,000, commissions for $75,000. So the total of variable costs are $200,000. The contribution margin is $300,000, difference between sales and variable expenses. Less fixed expenses. We do have general factory overhead, $60,000. Salary of line manager, $90,000. Depreciation of equipment for $50,000. Advertising, and this is a direct expense, of $100,000. Rent factory space of $70,000. General administrative expenses of $30,000. The total of fixed expenses are $400,000, and we do have a net operating loss for this segment of $100,000. So we are losing from this segment $100,000. That's why the management thinks about stopping or discontinuing this line or segment. Now, which is important actually. Investigation has revealed that fixed general factory overhead and fixed general administrative expenses will not be affected by dropping the digital line or watch line. The fixed general factory overhead and general administrative expenses assigned to this product would be reallocated to other product lines, which means these information or the numbers of these two expenses will be irrelevant. Why? Because we will pay these two expenses regardless of the decision taken. So if we stop or continue with the digital watches, we will have these two expenses. The equipment used to manufacture digital watches has no resale value or any alternative use. The question is, should the company retain, keep, or stop the digital watch segment. And this is the decision that the company is trying to take depending on these financial information. Now, we do have two approaches to calculate our advantage or disadvantage of dropping or keeping the digital watch line. The first and important approach is called the contribution margin approach. Contribution margin approach. Contribution margin means the comparison between what we have in the contribution margin compared with the fixed costs that can be avoided by stopping the line. Here, if we stop the digital line, go back to the income statement of the digital watches. If we stop the digital watches, we will lose the whole contribution margin of this line, which is 300,000. So the first line of the solution, according to the contribution margin approach, we will lose 300,000, the contribution margin lost if the digital watches line are dropped, or the digital line, if we decide to stop this digital line, we will lose the 300,000, which is the contribution margin of this line. Now, we will compare these loss of the contribution margin with the avoidable fixed expenses minus fixed expenses that can be avoided if we stop this digital line segment. The salary of the line manager can be avoided. So the 90,000, we will consider it as relevant information. The direct advertising expenses can be avoided, and this will be considered for $100,000. The rent for the factory space, 70,000, can be avoided, so it will be considered in our decisions. Now, the total fixed costs that can be avoided are $260,000 only. Compare this number with the 400 that we have already in the income statement. Look, go back to the question. The total fixed expenses are $400,000, but the general factory overhead, which is 60,000, cannot be avoided if we stop the digital watch or if we retain it or keep it. The depreciation cannot be avoided. The general administrative expenses cannot be avoided. So we will consider only the expenses that can be avoided only. So the 260 is the total of the fixed costs that can be avoided if we stop the digital watch line. Compare this number with the loss of the contribution margin if we stop the digital line watch, the digital watch line. So if we stop the digital line, we will have a disadvantage. Disadvantage means we will lose more if we stop the line. Comparison between the 300,000 lost in contribution margin and the saving in the fixed cost that can be avoided only. So we do have 40,000 between brackets, which means we will lose more if we stop the line. So the final answer will be the financial disadvantage of dropping the digital watches line will be 40,000 between brackets. The level solution can also be obtained by preparing comparative income statements showing results with and without the digital watch segment. We started with the contribution margin approach, which is more important actually because it is directly related to analyzing the decision. So we start with the contribution margin approach. We do have another approach called comparative income statement approach, which means we will prepare the income statement for the two situations. The first situation if we keep the line, and the second situation if we drop the line. Look at the comparative income statement in this slide. We do have in the first column the current situations, which is the income statement of the digital watch line. So we are losing 100,000 as a net operating loss. Now, the second column, if we consider that we are dropping the digital line or digital watch line, we will lose the whole sales for an amount of $500,000, and we were not paying all variable expenses. So we will lose the contribution margin. So the second column includes zeros for the sales and all variable expenses. So if the digital watch line is dropped or stopped, the company loses 300,000 in its contribution margin first. Second, if we're talking about the fixed expenses, general factory overhead, we will pay the 60,000 if we keep the line, and we still paying the 60,000 if we drop the line. The general factory overhead will be the same under both alternatives. So this amount is irrelevant for our decision. So the difference in the third column will be zero because we are paying the amount if we keep or drop the line. Salary of the line manager, we will pay the 90 for the current situation, but we are not paying this amount for the second column. The depreciation is, look, the salary of the manager would disappear for the second column, so it is relevant to the decision. The 50,000 depreciation is a sunk cost. Also, remember that the equipment has no resale value or alternative use. So the equipment and the depreciation expense will associated with the decision are irrelevant to the decision. Why? Because we don't have any resale value for the machine. By the way, suppose that we do have a resale value for the machine, so we will stop the depreciation for the second column, right? Okay. The next, which is the advertising, we can save the advertising, so it will disappear in the second column. The rent can be disappeared in the second column, which means it is relevant depending on the question. And the last one, which is the general administrative expenses, this is irrelevant. Why? Because we are paying this amount under the two alternatives. So the third column will be zero. We are not saving anything in the general administrative expenses. Totals for the fixed expenses are 400 compared to 140 for the second column. So we are saving 260,000 for the third column, which is the difference between the two columns. Now the net operating loss will be 100,000 loss for the first column, but, and this is important, we will have a loss for the second column of $140,000. Look, we are losing more if we drop the digital line. So the difference, which is the third column, the complete comparative income statement reveals, or statements reveal, that the company would earn 40,000 of additional profit by keeping or retaining the digital watch line. In this case, we are or we have more loss if we drop the line. If we stop the line, we will have more loss of $40,000. So the decision should be not advising the company not to stop the line or to keep the line. Be aware that the allocated fixed costs can distort the keep or drop decision. The levels managers may ask, why should we keep the digital watch segment when it's showing 100,000 loss? Our answer in the managerial accounting, we will say the answer lies in the way that we allocate the common fixed costs to our product, which means we do have something called unavoidable common fixed expenses, make the product line appear to be unprofitable when in fact dropping or stopping the product line would decrease the company's overall net operating income. So again, the last answer from the managerial accounting say that we have to keep our line. Why? Because if we stop the line, we will lose more, which means the company will have a profit if they keep the line. That's all. Thank you.